Silver just exploded 22% in a single session, $65 to $78. That's not a bounce, that's panic covering. Bitcoin ripped $11,000 in 24 hours, reclaiming $70,000. $340 billion flooded back into crypto, $1 trillion added to US equities in 2 hours. The Dow hit a new all-time high. The Russell 2000 added $100 billion and erased yesterday's bloodbath like it never happened. This is not recovery. This is the oscillation before the break. Same pattern, same sequence, same outcome. You're watching the exact price action that preceded 3 empire-ending currency collapses in recorded history. Rome in the 3rd century, the Dutch in the 1780s, Britain in 1931. Each time, markets whipsawed violently in the final months. Each time, the authorities called it volatility. Each time, it was the mathematical prelude to systemic failure. We're not approaching that moment. We're inside it. And if you understand what's happening in the silver market right now, you'll see the countdown clock that everyone else is ignoring. Let me take you back. Rome, 235 AD. The denarius, backbone of Mediterranean commerce for 3 centuries, contained 95% silver under Augustus. By the time Diocletian took power, it was 5%. The empire didn't collapse because of barbarians. It collapsed because the currency died first. Soldiers refused pay. Merchants hoarded metal. The price of wheat in Egypt went from 8 drachmas per bushel to 120,000 in a single generation. Hyperinflation isn't a policy failure. It's the terminal stage of monetary fraud. Rome debased, then convulsed, then fell, verified. Fast forward to 1780, the Dutch Republic, the financial superpower of the 17th century, controller of global trade routes, inventor of the modern bond market. Then came the Fourth Anglo-Dutch War. Britain blockaded the ports. Amsterdam's credit markets froze. The guilder, once harder than gold, became a joke. The Dutch East India Company, the largest corporation in human history, went bankrupt. Within a decade, the Republic ceased to exist, absorbed by France. The empire that financed the world couldn't finance its own survival. The smart money left before the cannons fired, verified. Now Britain, September 1931. The pound sterling, reserve currency of the largest empire on earth, backed by gold trusted for a century. Then the Bank of England announced suspension of gold convertibility, not temporarily, permanently. Within weeks, 25 countries followed Britain off the gold standard. The entire global monetary system collapsed in a synchronized default. Currencies that had been stable for generations lost half their value in months. The British Empire didn't end in 1947 when India got independence. It ended in 1931 when the pound died. Everything after that was just the funeral procession. Verified. 3 empires, 3 currencies, 3 collapses. The pattern is identical every single time. Stage 1, currency debasement to fund wars and welfare. Stage 2, loss of confidence among foreign holders. Stage 3, sudden violent repricing of hard assets as paper is abandoned. Stage 4, systemic collapse. You can't unsee it once you know the sequence. And right now, the United States is deep into stage 3. Let's talk numbers. U.S. federal debt is $36 trillion. Mandatory spending plus interest now exceeds total federal revenue. That's not a deficit problem. That's a solvency problem. The government is functionally bankrupt, held together only by the dollar's reserve status. But that status is eroding in real time. The BRICS nations are settling oil in yuan. Saudi Arabia is accepting renminbi for crude. China and Russia haven't bought U.S. treasuries in size since 2021. The bid is disappearing. When the bid disappears, the yield explodes. When the yield explodes, the currency implodes. Not might happen, will happen. This is mathematical certainty. Now look at what just occurred in the silver market. Spot silver dropped to $65, a 47% crash in 7 trading sessions, the largest drawdown in a bull market since 1980. Mainstream headlines called it a correction. They said fundamentals had changed. They said the bull market was over. Then, in less than 24 hours, silver rocketed back to $78, a 22% moonshot. Bitcoin surged 17%. Ethereum ripped 18%, reclaiming $2,000 from a low of $1,750. $550 million in short positions were liquidated. Risk assets across the board exploded higher in a coordinated reversal that looked nothing like organic price discovery and everything like forced covering. Here's what they're not telling you. The silver lease rate in London just spiked to 6.1% for 1-month contracts. That's the highest rate in years. A lease rate is what professionals pay to borrow physical silver. If silver were abundant, if supply were loose, that rate would be near zero. It's not. It's 6.1% and climbing. That means physical metal is so tight that traders are paying a premium just to access it for 30 days. The paper price crashed, but the physical market is screaming shortage. You can't hide that contradiction forever. Silver remains in backwardation. That means the spot price is higher than the futures price. In a normal commodity market, futures trade at a premium because of storage and carry costs. Backwardation is the market's way of saying, we need metal now, not later. It's a stress signal. And it's been flashing red for weeks. The Silver Investors Index is at 106.35 and rising. Open interest in COMEX gold just hit 952 contracts, the lowest level since December 14th, 2018. That's a 6-year low. Speculators have been flushed out, leverage has been destroyed, weak hands are gone. And when open interest is this low, it means the next wave of buyers will have to chase price higher because there's no one left to sell. Now, let's go to China. Since 2020, Chinese silver vaults have drained approximately 6,600 tons. That's a 90% draw in 6 years, equivalent to 30% of total annual global silver supply. The Shanghai Gold Exchange and the Shanghai Futures Exchange combined hold roughly 850 tons of silver. On February 5th alone, another 73 tons were withdrawn. At that rate, Chinese vaults will be completely empty in 11 days. Not 11 months, 11 days. China is the world's largest consumer of silver. They're not selling into this dip. They're stacking into it. And when the vaults are empty, the world will find out what real price discovery looks like. Here's where it gets dangerous. March 2026. COMEX silver contracts represent 429 million ounces of exposure. The registered inventory, the actual physical silver available for delivery, is 103.5 million ounces. That's a 4-to-1 mismatch. In February, 98% of contracts stood for delivery. That's almost unheard of. Normally, 95% of futures contracts are cash settled. But in February, buyers demanded metal. 18.72 million ounces were delivered out of 19.11 million ounces of open interest. In January, 49.4 million ounces were delivered, 7.27 times the level seen in all of 2024. The drainage rate is 785,000 ounces per day. If March sees even 50% of contracts demand delivery, that's 214 million ounces of demand against 103 million ounces of supply. If 70% stand for delivery, that's 300 million ounces against 85 million available after continued drainage. Now, the math doesn't work. The COMEX is 21 days from a delivery crisis that could force a complete repricing of silver. But here's the unresolved tension. Did we just witness the bottom at $65 with this 22% surge confirming the low? Or is this a relief rally inside a larger collapse? Because Bitcoin's long-term structure is flashing a warning that everyone wants to ignore. Every major Bitcoin bear market in the last 14 years has seen a drawdown of at least 75% from all-time highs, 93% in 2011, 84% in 2015, 83% in 2018, 76% in 2022. The polynomial trend suggests each successive bear market gets shallower, but the next projected trough still points to roughly 70%. A 70% drawdown from Bitcoin's $100,000 all-time high implies a bottom around $30,000 to $38,000. Bitcoin is sitting at $70,000 right now after bouncing from $59,000. If history repeats, and it usually does, we could see another leg down that takes the entire risk asset complex with it. Silver and Bitcoin are correlated. Not perfectly, but directionally. When Bitcoin dumped 35% over 3 weeks, falling from $90,000 to $60,000, altcoins and BTC pairs actually rose 11%. That's a signal that high beta assets are showing relative strength even as the flagship crypto weakens. The Russell 2000 is up 3.1% today, adding nearly $100 billion in market cap, fully recovered from yesterday's dump in green on the weekly chart. Small caps are outperforming large caps. That's risk-on behavior. But it's also the kind of behavior you see during a bear market rally before the final leg down. The pattern is clear. Assets crash and recover every single day. The same wild oscillation over and over, all through 2026. At some point, you stop calling it volatility. You start calling it what it really is, controlled demolition. Let's talk about what's not being reported. Iran just refused to end nuclear enrichment in talks with the United States. The U.S. immediately announced new oil sanctions. Iran refused to let Trump save face. What comes next could be significant. Geopolitical risk is repricing. When risk reprices, capital flows to safety. And in a world where currencies are being debased and governments are bankrupt, safety is not bonds. Safety is not stocks. Safety is tangible assets that cannot be printed. Gold, silver, land, food, energy. The things that matter when the system breaks. Here's the perspective you need. In mid-December, silver was at $65 with an RSI near 80, and everyone was bullish. Now we're back at $65, but the RSI is at 30, and sentiment is bearish. Identical price level, completely inverted psychology. Does that guarantee we've bottomed? No. Markets can stay oversold longer than logic suggests, especially during deleveraging events. The 47% crash happened in 7 trading sessions. That shows how fast sentiment can flip. Violent moves down often lead to violent moves up. Often, not always. But let's overlay the structural data. COMEX gold open interest is at the lowest level since December 2018. The silver lease rate is 6.1%, signaling acute physical tightness. Silver is in backwardation, meaning immediate demand exceeds future expectations. China's vaults drained 73 tons in a single day. At this rate, they're empty in 11 days. Registered COMEX silver is 103 million ounces versus 429 million ounces of March exposure. February delivery rate was 98%. These are not signs of abundant supply. These are signs that paper leverage is being flushed while the physical market tightens like a noose. Now think about silver miners. In the 2002 to 2011 bull market, silver rose roughly 300%. The top silver producer, Pan American Silver, soared 1,500%. That's 5 times the metal's gain. The average silver miner historically delivers 3 times the move of the underlying metal. But in 2285, silver ripped higher and the miners barely kept up. The SIL ETF lagged badly, in some cases underperforming physical silver. Why? Because analysts were still using old models. They were pricing miners based on $35 to $40 silver, looking through the rearview mirror while the metal traded at $80, $100, $120. But this month, the big miners start reporting earnings. Producers will show explosive cash flow from higher realized silver prices. A 10 million ounce per year producer is making your own 200% more profit per ounce than it was when silver was $30. You can't ignore those numbers. Analysts will have to upgrade valuations, and when the upgrades come, the miners will catch up to the metal in a violent repricing. Gold miners provide the precedent. Gold climbed from $1,300 in 2019 to recent highs around $5,500. Many gold miners lagged initially, then exploded. Agnico Eagle went from $40 to $300. The same pattern is setting up in silver miners. They lag the metal, then they catch up in a parabolic move that dwarfs the metal's gain. Silver miners lag gold miners, but the catch-up phase is beginning. And here's the structural constraint that makes this inevitable. Bloomberg reported that banks don't have infinite balance sheets to trade precious metals. That's the key. The suppression of silver and gold prices through paper contracts and derivatives requires massive balance sheet capacity. But Basel III rules, capital requirements, and leverage restrictions mean that capacity is finite. They can't suppress price forever with unlimited paper. When physical demand overwhelms paper supply, repricing happens. It's not a question of if, it's a question of when. Let me paint you a picture of what this looks like for a normal person. You wake up one morning and the ATM says your daily withdrawal limit has been reduced to $100. Not because your account is empty, because the bank doesn't have cash. You go to the grocery store and the price of eggs has doubled since last week. Not because of a supply shock, because the currency is dying. You try to buy gas, and the station only accepts cash or gold. Credit cards are declined across the network because the payment rails are frozen. Your retirement account shows a balance, but when you try to withdraw, you're told there's a 6-month processing delay. This is not fiction. This is what happened in Argentina in 2001, in Greece in 2015, in Lebanon in 2020. It's what's happening in Turkey and Egypt right now. The pattern is always the same. First, they tell you everything is fine. Then they blame external factors. Then they restrict your access to your own money. Then they change the rules. Then the system collapses. And by the time the average person realizes what's happening, it's too late to protect themselves. We are not at the cliff. We have already walked off it. The question is not whether the collapse happens. The question is how long the illusion can be maintained before reality forces recognition. Right now, the silver market is the canary in the coal mine. The violent 22% bounce from $65 to $78 is not a sign of strength. It's a sign of stress. It's the market trying to reprice in real time, being pushed back down by paper, then snapping back up as physical demand overwhelms the manipulation. This is what a breaking market looks like. It doesn't break cleanly. It oscillates with increasing violence until the structure fails completely. Here's what the smart money is doing. They're not waiting for confirmation. They're not waiting for the bottom to be officially called. They're not waiting for CNBC to tell them it's safe. They're accumulating physical metal at every dip. They're moving capital out of the banking system and into hard assets. They're buying land, they're buying productive assets, they're getting out of paper and into things that have value independent of government decree. Because they understand something that most people don't. This is not a market cycle. This is a wealth transfer. Wealth is not being destroyed, it's being moved. From those who hold paper to those who hold real assets. From those who trust the system to those who understand the system is designed to fail. So where does that leave us? Silver rocketed 22% from the $65 low. Bitcoin reclaimed $70,000. Crypto added $340 billion in a day. U.S. stocks added $1 trillion in 2 hours. The Russell 2000 recovered fully. Risk on returned with shocking violence, but the structural tension remains. Bitcoin's long-term pattern suggests a 70% drawdown is still possible, potentially taking us to $30,000 to $38,000. That would likely drag silver lower in the short term. More volatility is coming. Confirmation is still developing. But the COMEX data, the lease rates, the backwardation, the Chinese vault drainage, all of it points to physical exhaustion. The selling pressure is spent. The weak hands are out. The leverage is flushed. What's left is a market that's about to reprice based on physical reality rather than paper fantasy. You have 21 days until March 1st, first notice day for COMEX silver delivery. You have 11 days at current drainage rates until Chinese vaults are empty. You have a 6.1% lease rate telling you physical is tight. You have 429 million ounces of paper exposure against 103 million ounces of registered inventory. You have a delivery rate of 98% in February. You have a historical Bitcoin bear market pattern suggesting more downside is possible. And you have a precious metals bull market that is structurally intact despite the violent correction. This is not about trying to predict the exact bottom of the market or pretending that anyone can perfectly time price movements. That mindset usually leads people into emotional decisions and costly mistakes. Instead, this is about understanding something much deeper. The system itself has been rigged for decades, built on leverage, narratives, and artificial stability. And now, that rig is starting to fail. The cracks are becoming visible. The illusion of control is fading. When systems based on manipulation and excess finally weaken, they don't unwind slowly. They break suddenly. For years, we've been fed reassuring stories by the same institutions and commentators. We were told inflation was temporary. We were told the banks were safe. We were told that exploding government debt didn't matter. Each time, these narratives were delivered with confidence and authority, and each time they collapsed when confronted with reality. Now, those same voices are telling you that silver's bull market is over, that the opportunity has passed, and that it's time to move on. History suggests otherwise. They are not wrong because of hype or speculation. They are wrong because the underlying math no longer supports their claims. Beneath the surface, something historic is unfolding. The physical silver market is separating from the paper market that has controlled prices for decades. Through futures contracts, derivatives, and excessive leverage, far more silver has been sold on paper than actually exists in vaults. 1 ounce of real metal has been promised multiple times to multiple parties. This system only works as long as investors remain satisfied with paper claims and do not demand physical delivery. But that behavior is changing. Industrial demand is growing. Investment demand is rising. Institutions are accumulating quietly. Meanwhile, available inventories continue to shrink, removing the buffer that once kept the system stable. As this separation accelerates, price discovery will no longer be managed through derivatives and financial engineering. It will be driven by real supply and real demand. When that transition completes, the repricing will not be slow or orderly. It will be sudden and severe. Markets that are artificially suppressed for long periods tend to snap back with extreme force. That is why the coming adjustment, when it arrives, is likely to be historic. None of this means risk has disappeared. Volatility remains part of the process. Corrections can still happen. Broader financial markets remain unstable, and assets like Bitcoin may still experience downside based on historical cycles. Liquidity conditions may tighten further. Anyone ignoring these realities is being irresponsible. However, short-term fluctuations should not distract from long-term structural trends that continue to strengthen. The silver market is showing clear signs of extreme tightness. COMEX inventories are thin. Delivery pressure is increasing. Lease rates are rising, signaling stress within the system. China's vaults are being drained while demand across Asia continues to expand. These are not opinions or internet rumors. They are measurable indicators that point toward a market under strain. Even the recent 22% bounce from $65 was not random. It represented the first visible crack in a pricing structure that has been maintained for years through intervention and leverage. This is why discipline matters more than ever. Investors must understand their own time horizons and risk tolerance. Short-term traders must accept volatility as part of the game, while long-term investors must stay focused on fundamentals. Emotional reactions to daily price movements can destroy otherwise solid strategies. Decisions should be based on verified data, not headlines, social media trends, or fear-driven narratives. Due diligence is essential. Every investor must understand both the opportunities and the risks. No market is guaranteed, and no asset is immune to downturns. But ignoring structural warnings because they are uncomfortable is far more dangerous than acknowledging them. This is not about making bold predictions or chasing quick profits. It is about recognizing repeating patterns in financial history. We have seen this sequence many times before. Excess leverage builds up, prices are artificially controlled, inventories decline, demand rises, confidence erodes. Then, suddenly, the system reprices. The pattern remains consistent, even when the players change. The only real question is whether you will recognize what is happening in real time, or whether you will accept the official narrative until it collapses. By the time most people realize the truth, the opportunity has already passed.